Good morning to those of you tuning in from the Americas, and good afternoon or evening to those of you tuning in from elsewhere. Thanks for joining us. I am obviously not Keith McCullough, but this is day 3 of the Hedgeye Investing Summit, and you will be hearing from Keith shortly and at length, perhaps almost certainly at greater length than many of you expected. This is due to a programming change catalyzed by some technical difficulties that our originally scheduled guest, Pippa Malmgren, has encountered in her worldly travels. We do hope and expect to get Pippa back on for a broadcast conversation with Keith in due course. In the meantime, I am going to moderate a real conversation between me and Keith. There he is. And it's going to be structured, as Keith knows, to achieve 2 primary aims. First, we want to try to knock down some pins, so to speak, that were left standing from the 6 prior conversations in this year's summit, or I should say this summit, that unfolded yesterday and the day before. And my second aim, frankly, is to elicit Keith's answers to some questions that I've really wanted to put to him for a very long time, including 2 questions that will come at the end as a bit of a teaser that I posed routinely when I conducted gab fests that are similar to the Hedgeye Summit on a more or less annual basis during my many happy years as CIO of the Investment Fund for Foundations. So we have called an audible here. I hope you'll bear with us. It's going to be fun. And Keith, I'm going to call an audible on an audible. You don't even know this, but I happened to tune in. I almost never do this, but I tuned into Bloomberg TV a couple hours ago, and I saw Jonathan Gray, president and CEO of Blackstone, being interviewed by 2 very skilled interviewers, one of whom you mentioned on the call this morning. And I'm going to just read you. I'm going to ask Eric to flash. These are literally John's words. And I have to say, Keith, I thought he was absolutely brilliant in displaying something we will talk about at the end of this conversation between you and me, which is grace under pressure. It was really remarkable. I'm going to let the audience, if they can, if it's legible, read these 2 quotes in their entirety now or at their leisure later on. I'm going to just read a sentence or 2 from each. But he started out, he got some pretty tough questions. And the opening question I thought was quite tough and well put. And he said, I would just say we are incredibly proud of the quarter. We protected investor capital, and that performance is ultimately what's going to propel us forward to raise more capital. Skipping ahead. We really think we have the right model. We've got staying power. We can hold assets in a difficult period and firepower, nearly $200 billion to deploy. Then skipping ahead, when he was asked specifically about mark-to-market valuations in private investing, specifically in private realty, in the context of BREIT, well, I think you see it in the stocks of the public REITs. They've traded off very dramatically. Some of the big public office companies are off 50, 75%. So you've seen in the private market, valuations in the limited trades that are happening are down significantly. I think some folks in terms of private funds may not have marked fully to what's been happening. I think you'll see more of that. We tend to be ahead of the curve on those things. I got through the entirety of that, Keith, without laughing, but I'll ask you to discuss.
Well, now I know why Blackstone is squeezing me, because I'm shorted. This is,
He's good.
It's an amazing thing. I mean, we were talking about this, Jay Van Sciver and I, this morning on the call, as I'm sure you listened in on, and just talking about the wherewithal of Elon Musk and his ability to tell a story. And I think that we're in that, it's called a gish galloper, by the way. I was comparing Trump to Elon, whatever side of this political spectrum you are, whether you love them or hate them, it's not the point. It's that we live in an era where what people say is believed readily by people who wouldn't have any experience or any context or any really any wherewithal to know otherwise. And I think that's a sad thing, in particular because people end up getting hurt, losing a lot of money. And in the case of BREIT and Jonathan Gray, I mean, come on, man. I mean, like it's one thing to be misleading. It's another thing to be arrogant about it. I mean, I think that those comments like, we had a great quarter, we're just better than everybody else, haha, we didn't have to take our marks. And you know what? To our investors that asked to redeem their capital, all this capital that we're talking about that we were able to keep, we told them to go pound sand. I mean, I think it's terrible, actually. I think it's in terms of the principle of the comment in both regards, misleading, and at the same time, there's no real humility in that at all. I mean, I don't get it.
All right, so let's move forward. We'll both try to be real humble because I think we're sort of inherently that way. What I want to turn to is the next question that I'm going to put to you is one that's really much on my mind. And I know you because we were both in the office together on Tuesday, and you saw me sitting in the main conference room with Simone, Rob, our REIT specialist, Rob Simone, great guy. And we were there for, a really long time, just chatting, the two of us. And you walked by several times. You're probably wondering what we were talking about. And what I was doing was listening, questioning, and maybe I did a little coaching, and we'll come back to that because you did that remarkable conversation with Gio yesterday. But what I kept asking Rob is essentially, are you bearish enough? It's really risky as an investment professional to do something that could potentially cause you to be wrong and alone. But are you bearish enough? So I'm going to put the same question to you. You did a remarkable series of conversations in the first 2 days of this summit where you were flagging, as well as Aisha Tarek did it, Liz Ann did it, noting that the pretty big gulf between where they and Hedgeye are on the one hand, on sort of expectations for this year in particular, and where the street or consensus is. So let me turn it back to you and let you discuss that challenge. Yeah, are you bearish enough?
I think I am. I in a way, being bearish enough. I mean, to a degree, we're talking about how we position. Now, of course, we're over. The more bearish we are, the more bullish we are on something like gold, becoming quite bullish on things that are today is just a day. But I do think that the phase transition has begun where you could be outright bullish on duration or long-term treasury bonds. So I think. Being bearish, I think in its proper kind of nomenclature, how people think about bears is that, look, we're just bearish on the economy, we're bearish on growth, we're bearish on bubbles. In fact, the mother of all bubbles. I don't really know, David, how many more ways I can express my bearishness on this front.
Yeah.
So,
yeah.
I mean, I really try every day because it's such a, back to the Jonathan Gray thing. I mean, there is, if there's ever been a head wall of the other side of what I believe, I mean, it's as strong as it could be. And I've seen a lot of bears actually capitulate to going bullish, I mean, on the economy and on growth. So I think, at this juncture, I'd say I'm adequately bearish.
Yeah. All right. So, and the pressure to do that, to sort of cave in or capitulate, is enhanced by something that you've referred to repeatedly, and I think really aptly, as the machine. Now, consistent with my aim here over the next roughly 40 minutes, because we've got a tight stop at the 45-minute mark, as I think you know. Consistent with my aim of sort of helping people learn how to fish and maybe handing them some fish at the same time, that old adage. I want you to talk about, because I think in my travels and conversations with sort of members of Hedgeye Nation, I think many of them get confused. They hear you talk about the machine, and they think because Hedgeye is so commendably data-driven, that you're referring to our own machine, our own model, our own process, something we'll get back to at the end of the conversation when we talk about what Gio talked about. But that's not what you mean, nor is it what we hear Ray Dalio talking about so much, because when he refers, which he does repeatedly, and I think also commendably, to the machine, he means the way capitalism as an economic system functions. But that's not what you mean. So tell us again, and particularly for newer members of Hedgeye Nation, what you mean by the machine and why it's so dangerous in producing the kind of capitulation that you alluded to just a minute or two ago.
Yeah, and I think commendably is the right word for what Dalio produced. He's got a great visualization of it. It's in cartoon form, and it's very well done. They spent a lot of time, Bridgewater did on that. What I'm talking about, and by the way, I agree with the rates of change of the machine, the economic machine, as he refers to it that way. But when I talk about the machine, I talk about the flow. Like we're talking about the flow of assets, the daily trading of assets, the manipulation of assets, the introduction of YOLO or super short-term options impacting the flow of the machine. And on this slide, thanks guys, this is the really the manifestation of the machine where you've gone from passive being pretty much a nothing burger when I started in this business 25 years ago to and really the flow being dominated by hedge fund block trading. That's when I started. To now, if you don't front run the machine and how it not only the machine is very smart in the sense that it front runs Ray Dalio's definition of the machine, the economic machine, but the machine itself is constantly being manipulated and perpetuated by the very well understood by sophisticated and large investors reality of the situation, which is you can really push things to different limits where people will be forced to make bad decisions. And we also call that being the uninformed volume. So we have a solution for that, which is, of course, the risk ranges. But to me, that's what it is. It's the flow.
Yeah. I want to come back to that because I have my own vision of what machine means in our context, in our professional lives. That's related to the sort of longer term work that I'm working on at Hedgeye that you're acutely familiar with. But before we get there, I want to touch on something else. This is back in the sort of teaching people how to fish category, is this thing from handing them a fish, although there's quite a bit of overlap. But you say repeatedly, again, I think commendably, maybe we're overusing that word, that it's the particular that matters. Look, we both studied Mandelbrot, carefully, and it is the particular that matters. But you've also said, and you've given nice shout outs to your former mentor at Yale, Robert Schiller, that the first thing you learned at Yale that really struck in, got through your, as you call it, your thick skull, was this idea of the regression to the mean. A mean is an average. And so how do we reconcile this view that it is the particular, not averages, that really matter, with the notion that his concept of regression to the mean is actually quite important in investing, because they seem to be at odds with each other. This is never a question I've ever posed to you, and I certainly didn't give you this question in advance to think about. So
No.
Apologies if I'm putting the boss on the spot.
I think about it all the time. I mean, it's and the things that you think about, David, it's like the longer you do this, the more things you have time and space to think about, and most importantly, you have, with experience, you have time to put it in the context of your cycle. So, or in the context of your process. In this case, I think the answer is quite simply, it's mean reversion within cycles. I mean, so when you look at, and that's really what I'm just, now you've actually gone from one slide to the next. We're talking about like the foundational slides of the process. Guys, go to the slide after the machine. What I'm talking about is the very simple mean reversion of going to the top of the sine curve and then to the bottom of the sine curve within a cycle. The probability of that happening is extremely high, and it's consistent. There's a rhythm and rhyme to all these cycles, but the components of the cycle are always different. So, that, like if you look at like when Schiller taught me this was like pulling back long-term cycles, super long-term, beyond Neil Howe cycles, and that's what I'm talking about. You go from the top to the bottom and back again. It's actually, I name my book that too.
Yeah. So one of the reasons you do that, and Eric, if I could get you to go to slide, I think I'm going to start with slide 4 in my little deck that I put together on short notice for today. Yeah, thank you. So Keith, bear with me. It'll take about 60 seconds to go through several slides here. But when I alluded a couple minutes ago to the sort of the machine as I view it, I understand and respect your definition of machine. And equally, I understand and respect how Ray defines the machine. Now I'm referring to sort of a third machine, which is the way really big money, big endowments, big foundations, sovereign wealth funds, DB plans, the way they allocate capital. And they tend to do it, as you know well, pursuant to these pie charts or asset allocation schema. So what I've shown on this slide is in the upper panel is sort of the traditional view of how you allocated institutional money when I got into the business years ago. It was sort of 60-40, 70-30. And we went from the top A to the bottom B, where you get these pie charts where, we like to say that our strategy at Hedgeye is, sort of go anywhere. This strategy, I think, is aptly defined as go everywhere, which means you have to own a little slice of everything. So if you could go to the next slide, Eric, right? And you could say, well, how did we get from A to B? And this is my depiction of it, right? We go back to the original prudent man rule, diversification, then Swenson comes on the scene, pioneering portfolio management. And I was a huge fan. I love David. He was just a great human being. And then everything that he did got turbocharged, this massive march, the parade of the elephants into alternatives, aided and abetted by sort of easy money. Next slide, Eric. Oh, yeah, thanks. So now we come on to this. This is actually a real live asset allocation policy mix from a leading university endowment, a big one. And I want to draw your attention, it may be hard for you to see, Keith, to the bottom row, which is called liquidity. So you have this sort of go everywhere strategy up above. When you look really carefully at the allocation to cash, the normal allocation, the current policy allocation and the long-term allocation to liquidity is zero. Now, admittedly, as at a 10% max, but what I'm trying to do here is, and I gave our colleague Jeremy McLean a shout out overnight, as you know, on connecting the dots, right? What Gio called differentiated thinking in one of the 5 tools that he flagged in his talk with you yesterday about how do you achieve enduring success in really any field of human endeavor. Okay, again, we'll come back to it. But what I'm trying to do with you right now, Keith, is get you to help me connect the dots. Because when I hear, for example, that, Blackstone has, 40 billion of dry powder, or there's so much dry powder in private equity or even in venture capital, I ask myself, where precisely is that dry powder? Because this university, I can tell you, I won't name the institution, but you can actually see it in their policy mix. They have massive holdings of private investments, and they have virtually no liquidity. So when the capital calls come in from the people that think and profess to be able to put a lot of dry powder to work, those other folks have to sell something. And they have to sell it, and you and I talked about it in our very first on-air conversation. They have to commit the cardinal sin of investing, which is to be an involuntary seller. And they have to do that to meet their contractual commitment to provide money when the managers call it. I'll stop there and ask you to discuss the phenomenon, because I think if you try to connect these dots, that's where I think you could get really even more bearish than you currently are.
Oh yes. When you take, especially when you go from, without going through every iteration of it that perpetuated it, the easy money being the most obvious, and it was appropriate that you started with Greenspan and went through Bernanke. I mean, if you really take a step back and you go, what's the difference between 60-40 and the everything pie? And what I love about you, David, is every time we talk, I learn something new. That's great. Like we have a go anywhere strategy, they have an everything strategy. Is that, the Blackstones of the world were the largest recipient of the everything pie. We have some of that. We have some of this. They have I call it pie chart macro, and we'll charge a fee on every part of the pie. But the real problem with that, of course, is when you have to compete with cash and you have to compete with a higher cost of capital and a respect for liquidity. So I think that's where you can get beyond bearish on the number one factor, by the way, that you want to avoid when you're in quad 4 to begin with, which is not having liquidity. So whether it be a corporate who cannot make their coupon payments, be somebody like Blackstone that can't make their B-REIT distributions, or otherwise, really what you're trying to find in a world where cash flows revenues are slowing, cash flows are slowing, liquidity is drying up, is you're trying to get long liquidity, right? So that is frightening. I mean, when you really think about how much of that money has to be, or should be, or that capital needs to be marked to market. And again, it puts Jonathan Gray's comments, I called it different things, but I mean, that it's beyond misrepresenting the risks associated with being invested in that at this juncture of the cycle.
Yeah, I'm glad you mentioned the word cycle because my next question for you, and it's sort of something you've recently introduced, and I was delighted to see it, as you know, because I gave you a shout out on it publicly. But this concept of cycle to date is distinct from year to date or month to date or quarter to date. So we have an opportunity. We're having a semi-unhurried chat here. Just explain for me, but more for the broader audience, what exactly you mean by cycle to date. How do you define a cycle, and what do you do, frankly, with an investment professional or investment committee, an allocator, an asset owner who sort of arrives mid-cycle? How do you help them understand that they are actually arriving mid-cycle and that they don't make the mistake of using the wrong metric, if you will, to assess evolving performance?
I mean, that of course is a terrible problem, but it doesn't, you don't get an answer because you have a problem. I tried to explain this through the lens of something people might really understand, like binge watching. Just because we're in season 5 of Yellowstone doesn't mean that you just get to, assume that you know everything that happened in the prior 4 seasons. That's where you're at. I mean, I can't change that. I can help you understand where we're at. Now, cycle to date is economically really easy to identify. It's where are you again on the sine curve of economic growth? Where are you on the sine curve of inflation? Where are you on the economic sine curve of the rate of change of profit growth? All 3 of those big cycles, the big 3 that I care about, they have a top, they have a middle, they have a bottom, they have accelerations and decelerations embedded therein. So what a lot of people get caught up in when they look at year to date is their own career risk management or their own covering of their ass or their own performance pressure. I mean, if you're at a hedge fund, I mean, your to date performance is like T minus 4 hours. I mean, or T minus a week at best. I mean, these performance pressures are real, but they should not be confused with cycle to date or where we are in the cycle itself. There is a defined date that that the quad 2 economic growth period peaked, which is in the 4th quarter of 2021. That's an empirical fact. That's not an opinion. So when you go back and you go, oh, look at the asset class that people called an asset class, I don't think it really deserves that respect yet. It needs more time and space of cryptocurrencies. I mean, that peaked on the same day that the Russell 2000 or smaller cap stocks peaked on November the 8th in the 4th quarter of 2021. Well, where did gold peak? Where did gold trough? Like these things are all measurable within the cycle. And I do think it's a disservice to the macro unaware, or people that get pablum or spoon-fed CNBC bullshit all day long about year-to-date returns, because it's easy, right? Like even the lowest quotient of financial analysis, which is a CNBC journalist, can pull up what the year-to-date return is or what the multiple of something is. I mean, that's talking about the average of things or the multiple of things or the returns of things. That's just like looking something up. Understanding something, and back to your point on Mandelbrot, that it's the particular thing that happens at a particular point in the cycle. Well, that's the most critical point. So you really need to know, when we're going towards the low end of the pool or the deep end of the recession, because that's when all the bad stuff starts happening, which in this case it just did.
Yeah, you're making this really easy for me because you just mentioned a journalist pulling up data. And my next question for you was going to go back to a comment you made in passing the other day, which I really found intriguing. Because you said, Keith, am using Chat GPT to pull up, well, fill in the blank. I'm really curious to know. And let me just say, and this will be kind of a test of your grace under pressure too, because you actually said, and I think it was a conversation with Liz Ann, but it may have been Lynn Alden, that last year was the worst year for the S&P since 1937, which is just flat wrong, right? So I heard it and I typed in Chat GPT, right? It's the 3rd worst year since 1937. 2008 was worse, and 1974 was worse, particularly when you add in 11% inflation in 1974. So you were talking a drawdown of almost 40% in each of those years versus a much more muted drawdown last year. But I started using it a lot. More as just a kind of a glorified search engine, but I was really interested when you mentioned it. How are you currently using it?
Well, it saves me time. I mean, I don't have to. So, for example, I'm still a creature of my own habits, and I got plenty of faults. One is that I'm stubborn when it comes to that. I will not get off my rocking horse in the morning in terms of my routine, the deliberate nature of it. So this morning, for example, I'm writing about Apple, and I'm trying to contextualize. what Apple is, not only as a percentage of the S&P 500, the all-time high as a constituent, 7.1%, but I wanted to go back and figure out what was the day that Apple peaked. So, and I could have easily just punched that into ChatGPT, like I did when I was writing my early look yesterday on oil, because I was saying Exxon, when it was the peak constituent, that's when the oil price was when. I popped it in ChatGPT, $147, I believe, a barrel in July of 2008. But the ChatGPT gave me that number. I should have done that this morning with Apple. Instead, I probably took 4 to 6 minutes and actually, scrolling over the price and making sure I had the right date, then thinking about it, and it was January the 4th at $179, if I recall correctly. So what that is just going to give people like me who have to deal in the space of empirical truths and historical realities, as opposed to narratives or whatever, that's only going to make us better. I mean, it's just going to make us faster. And when you have to play against good players to begin with, that's one problem. When you have to play against them and they have better information faster, it's just like watching an NHL playoff game. As soon as something happens, they don't look at each other. They look at the iPad. You see the whole bench looks at the iPad now. That's perfect. Now you can see precisely what happened. You have full information, and you can go on to your next play, which is really the most important point.
So next question is going to ask you to do something I know you're somewhat uncomfortable doing, again, commendably so, which is just exercise intuition and judgment as opposed to thinking about data. And the question is, it's also building on what we just talked about with ChatGPT, but as you've used the technology, can you imagine in the medium and longer term circumstances under which technologies like that make the allocation of capital a lot more efficient, and as a corollary, make it harder to bring alpha out of public securities markets?
Provided that it is the actual truth. Now, this is the risk, of course, is that everyone wants the truth and has wanted the truth, if only they want it to be their truth. So let's just call the current manifestation of social media just that. You need to believe this, therefore you believe this, so you're going to go to that source that can give you supporting data points. I mean, when you think about it, and considering the institutions academically that you and I went to, some of the most brilliant, and I mean highest IQ point, on paper, brilliant people that I know and that you know, they are some of the most impressive politicians and or media experts supporting those politicians that you're ever going to find, because it takes a big brain to be able to say one thing and know that the truth is on the other side, and just know how to knock down the truth data points really quickly. That's an amazing skill. Like people should be trumpeted for that, pardon the pun. But if we talk about it within the lens of like what I just said, those two things, like what was the day that Apple peaked? What was the worst return? I mean, total return last year, if you include bonds, was probably the worst since 1937. But we can check that up, right? We don't have to debate that. It can be immediately audited, and for Wall Street, I think in particular, because the old wall is one of the few places, David, as you well know, all the way, and in all of its manifestations, it includes the buy side, obviously, as well, all these investment committees, they have gotten away with not evolving where we as a society champion like something like AI instantaneously. Whereas you can't, in asset management, you're willing to believe any poppycock, any bullshit, anything to support whatever position you've already taken. Whereas you can quickly look up something like ChatGPT. When you enter a recession, do you buy tech? The answer is unequivocally no. Well, but bond yields are going down and we're done with the... No, just stop it. No, the answer is no. But you have a lot of people that allocate capital to tech with currently falling bond yields, thinking that the recession... And then the recession. Well, what is the recession? I mean, ChatGPT. Who's more accurate on their GDP nowcast, the Atlanta Fed or Hedgeye? Well, there's an answer to that. It's Hedgeye. So why do you believe the Atlanta Fed? Well, because I like that one. That's a soft landing. I think that the opportunity here is manifest both externally and internally. Internally, I want to use that in conversations with my analysts all the time, like you just did with me. I mean, we want to know what the right answer is, not one that is convenient. Yeah.
I'm trying to connect dots here that others might not seek to connect, or they might think it illogical to connect. But again, we're going to go from ChatGPT to as we enter the last third of this conversation to some really, I thought, really insightful comments that Gio made in particular in your conversation with him yesterday. By way of review, as most people know probably that are watching this because they watched that interview. If not, they should maybe stop this one if they're watching it on replay and go and watch that one and come back to it because it's really good. But what Gio argued, maybe even observed is a better verb, is that there are really only 5 ways to achieve sort of enduring, lasting success in any field of human endeavor, right? Superior talent, the superior work ethic, the superior process, sort of superior hiring, delegation, right? Finding the right people to be your team members. And then finally, differentiated thinking. And I've thought a lot about it since I heard him. I mean, I had encountered these concepts previously to your conversation with him yesterday, but I thought a lot about it overnight. And I was going to try to pose the paradoxical question to you, Keith, because what he didn't add as a 6th element is like experience, right? The wisdom and the judgment that comes from experience. And I could sort of immodestly say, look, I'm older than most people at Hedgeye. I'm certainly older than you. And look at me, aren't I wise? And I have all this experience. But I want to actually flip it on its head and say, can't experience, particularly in a market environment like this, become more of a handicap than a benefit in the following precise sense? That because we all want to recognize patterns, we try to fit these newly arriving data, and I talked about this in an earlier version of our Moab series, right? We try to, in the first part of it, the one that we did with Josh and you, that we try to fit newly arriving pieces of the puzzle into a pre-existing pattern. And that's where experience can actually become a handicap. So I want to ask you to reflect on what I've just talked about through the prism of where we are today, because of course, some of the things we're seeing look very similar to 2008 or to 2001. But again, we get back to Mandelbrot in the particular. Discuss.
Well, this is where, for me, the answer is the signal. Like when I look at the, not only the fractal construction of my signals, but the fractal nature of everything that's going on, embedded in that assumption that the world is fractal by nature is that there's a dynamism to it, that there can be regime shifts, that there can be whatever you can not think of. The signal is trying to get you there. That's the point. Okay. So for me, that's where it's there. Yeah, okay, I got experience in cycles. I got experience calling recessions and bear markets. But why this one did I not start buying utilities until the last in the last couple of weeks? Yeah. And any other one that I've risk managed, you would have bought utilities and lost money the whole way down up until starting to make money in them now. So and the signal saved me from the bias of the back test. The bias of the back test one could call the greatest experience because that's just what happened. Now, whether you did it, you executed against it well or not, I mean, that's everybody's own endeavor and experience. But I really, I get called a lot of things. I don't think I get called humble unless I'm having a conversation with people that I love and respect, and I'm not trying to present something on Hedgeye TV. But I think it requires the deepest of humility to obey the signal, to assume that I don't know anything and the market is trying to guide me to what I'm going to know. Like that is the most important thing that I wake up thinking about in the morning when I'm writing things down. Where is this leading me? And it will not be like the other cycle. Like I said, there's a rhythm and rhyme to cycles. There's mean reversions from tops to bottoms and back again. But the components, I mean, that's the market is constantly giving you hints and head fakes and everything else.
So if somebody said to me, it's not happening right now, but if somebody would whisper in my ear and say, hey, David, can you think of an example, like really recent, of what Keith just talked about? What would it be? I would point back just 3 hours earlier today to your discussion of what's going on with the dollar. Mm-hmm. Why don't you just use that as an example for just a minute or two to talk about, to illustrate what you just said about trying to listen to the signal. We don't know what signal it's going to ultimately give us, but help the audience understand what you're seeing in real time right now with the dollar.
Yeah, so if you guys go to slide 8, which shows the back-tested realities, and these things are listed in rank order of strength of return, quarterly return by asset class and sector style, for example. If you go back to slide 7, just to flash it to people so that they know we've done the work, that's going to burn your eyes out. But again, go back to slide 8, and you can see fixed income, gold, and the U.S. dollar in that order are where you want to be in quad 4. Now, we've been long the dollar for 16 months. It's the third ranked strength. I'm still long it, but I have a minimum position. And what I've tried to articulate this morning is the dollar may very well be just signaling lower highs and a much less of a return profile, i.e. less upside in the risk range, and certainly not back to prior cycle highs, because we're entering a particular point in cycle time of risk, sovereign debt risk, that is associated with the debt ceiling. And the last time we had the debt ceiling, the dollar weakened materially. That's back in 2011. Although Bernanke was committed to burning it to a 40-year low, let's be clear. Whereas now we have Powell, thank God, which is a different. Actually, I don't think I've ever thanked God, and I'll take that back. I will not thank God for a central market planner. but it's something that the signal's picking up. There's something here in the dollar that means keep the position small. And in 6 weeks or less, that chicken comes home to roost, of course, which is the debt ceiling catalyst itself.
Good. We've got 9 minutes to go. I've got 3 more questions, so we'll divide it roughly 3 minutes each. Of course, it'll take me a few seconds to pose each question. The first 2 are going to be the ones I alluded to earlier that I used to routinely do when I did something like this for TIFF for many years. So the first one, and I want to tell the audience, I gave these 2 questions, only these 2 questions to Keith in advance, because I found through experience, it's helpful for people to think about them. The first one I call my Mount Everest question, which came to me when that awful tragedy that Krakauer wrote about it Into Thin Air, and I know you're very familiar with it, unfolded on Mount Everest. And I reflected on the fact that of the non-Sherpas who died, none of them would have been on that mountain if the universe had a law saying, once you get back to New York or Boston or San Francisco or civilization generally, you can never talk about the fact that you climbed Mount Everest. None of them would have gone to Mount Everest. So it leads to a question. What is the single feat, F-E-A-T, the accomplishment that you would be keenest to accomplish, subject to the condition that no one would ever know that you'd achieved it?
My immediate response, because you're right, it takes a little while. I actually went and had a shower and thought about it. But because that's where I can think, because I can't hear anyone else. My quick response was, well, I put the puck in the back of the net for the Toronto Maple Leafs, at the end of Game 7, so that they could actually advance past the first round for the first time in since 04. But in all seriousness, I thought about this a lot, and what I would do, I would reduce the financial burden to certainly low income and maybe even middle income, like in terms of how I grew up, families on their ability to support in their family a child with a disability. Mm-hmm. That to me, having lived through it, is an extremely important thing to have the financial resources to be able to do. And I would love for the world to just have that, for the kids in particular, to have those resources.
Yeah, that's a great answer. It's actually a very good segue to the second question in the following sense. The second question I call my grace under pressure question, but you've seen so many times families with children with disabilities display incredible grace under pressure, because you know better than anyone in the world, because you've experienced it directly, just how much stress there is associated with that. So the grace under pressure question is, what is the greatest display of grace under pressure you've ever witnessed in real time, either in person or on TV, but replays don't count?
Well, this one again, after you think about it for a little while, I'd have to go with my dad on that, where an unbelievable, and I didn't get this, David, until I got to be a teenager, I would say, because that's when I recall it. And we'd moved to this house on Oakdale Crescent, and I can see it like it was yesterday. My dad's gear. My dad was a firefighter, and when he would come, and then I'd start to realize, well, that's what happens when something bad happens like when we're sleeping, when me, Mom, and Ryan and Cheryl are sleeping, like it's a really bad fire, that gear is being aired out with the garage door open, and that's one thing. It's something happened, and the grace to me is in him never showing whatever happened. Mm-hmm. Like showing that even as much as an inch of emotion or wanting of any type of support. I'm still in awe. So it happened multiple times, of course, and unfortunately. But to me, that's I'll never be able to get that out of me.
Yeah, understandably. So, final question. I'm going to kind of pull the goalie, or I'm the goalie, right? And just let you run out the clock, and you can shoot it into the empty net if you want. But we've got about 3 minutes left before we have to sign off. The question goes right back directly to what Coach Gio was talking about yesterday. I already talked about the 5 tools that you can have in your toolkit. And again, reflecting very carefully on it, talent, work ethic, process, differentiated thinking, savvy hiring. Those are the 5 tools. And I thought, I don't know actually anyone who's achieved enduring, lasting, significant kind of world-class success in any field of human endeavor who didn't actually have all 5. If you define the hiring broadly to include like hiring a coach, right? And I would put that question to you. Do you know of anybody who hasn't actually employed all 5 of those tools? And then I have a follow-up question, so I'll let you answer that relates directly to hockey, which is something you know a lot about and I know almost nothing about. It's a process-related question. But first, let you address the question of tools.
On like when it comes, I'm not going to get into things that I haven't done, but I mean, when it comes to things that I'm intimate about and have experience, they all require a team. I mean, and they all require these 5 dynamics. So absolutely not. I don't know anyone in the realm of hockey or investing that has been able to do that, solo shot on their own. No.
Yeah. So the fun question that I'll close with is, again, we're in NHL playoff season, but when we talk about process, one of the 5 tools, and there's no organization I know of in the world that eclipses Hedgeye in its emphasis on the importance of process, right? But I look at NHL games on the TV, and I think once leaving aside practice and drafts and conditioning and everything that goes on surrounding game time, but once the players get on the ice, I don't see a lot of process in the 60 minutes that unfold from the opening of each period to its close. What am I missing?
Well, I mean, you prepare. Your process is your preparation, both your mental, and your strategic preparation, your physical preparation, of course, as well. So you have to read and react. And every reaction to somebody else's action is based on your process. I mean, the preparations that you made getting into that. I mean, if you could see an entire lack of process, obviously. And that's maybe an interesting. I mean, that's an interesting handoff. I mean, to today's analog that we're trying to help people see not a hockey game, but see a full investing cycle game. Like, they have so many things that they think that they should be looking at because they've been watching CNBC and, I know why you're watching Bloomberg. You just wanted to watch what Jonathan Gray was going to spew today.
That's right. Exactly.
But that's really the challenge, is to see all the unique things that a professional does when playing anything, including the full investing cycle game at the highest level. That's our goal. It's tough. It's tough to get, just like anyone else. Ask somebody. Go ask Wayne Gretzky to teach you how he shot a certain puck at a certain time at a particular point in time in game, and it's going to be tough.
Yeah. Well, we're going to break it off there. This has been fun. I think you've done a good job on this. I'm going to invite you back to do this again. And I know you've got like 10 minutes to go, and I'm going to be standing by for real-time alerts between now and you've got 2 more sessions to finish up the summit today. And I know they'll both be good ones. So thanks, Keith, for the conversation. Appreciate it. And thank you all for joining us, and we'll see you next time.